On today's show, 3 questions. Number 1, Genki desu? Number 2, are 4Ks propping up the Mag 7? And number 3, is it better? Sorry. And number 3 is renting back. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
And I'm Rabih.
Yeah, you are, Rabih, and you're getting meaner. We were joking last week about making me, I'm literally sweating. So we spent a solid 10 minutes on pronunciation of Japanese, how to say, how are you in Japanese. Last week was Chinese. This week is Japanese. I guarantee you, I can't even tell you how many people have offended, I'm sure, at this point. But here we are.
Don't blame me. Blame the government shutdown. There's no data.
I was going to say, this is what happens when the government shuts down and there's no data for Rabih. He just tries to make me speak other languages and sound like a complete idiot. Anyway,
I think you did a good job. If
did I do
someone
okay?
understands Japanese and listen to this, please let us know about Matt's pronunciation.
I was literally on Google Translate. Man, here we go. Okay, we're jumping in. This is what 2 cents has devolved to. Number 1, Rabih, what's happening to Japanese stocks?
Yes. So this is a very evolving topic, and probably by the end of the day, and when you listen to this tomorrow, it could be different, because I came in to check the data and it changed from the research that I've done last night. But the Japanese stocks earlier this week made a new all-time high and went up around 5.6% in one day. This morning, they retracted back by like 1.5. But I was very interested to understand what led us to here. So I know we don't talk about Japan every single week, so here's a quick summary about Japan's economy from the last couple of years until now, and what has been happening to the stock market and what explains it. But do you guys have a guess of what the performance of Japanese stocks has been year to date?
You asked me to do this with China last week. I had the answer right in front of me. Still didn't look at it and have the answer.
You don't have
the answer on the chart, so
I'll guess 20%.
I was going to say
20, yeah.
22%.
Oh, are you sure you weren't cheating?
I'm not.
Okay, so before this morning's, I would say, pullback, the stock market in Japan was up 25%. Now we're down year to date for it being up 18.5, almost 19%. This compares to an 18% for a globally diversified portfolio and a 13.27 for the whole US market. So it's in line with a globally diversified portfolio. It's not an outperformer, it's in the average, but it's a really good year, and it just made an all-time high. So trying to explain this, let's just go back a couple of years to what the situation in Japan was and how it has evolved. So in Japan, during COVID, they had a similar path to domestic markets. The turning point where Japan's economy diverted from the rest of the world was in 2022 when there was inflation. Just to give you some reference, Japan, for those who were alive in the 80s and old enough to understand what was going on, Japan was the China of that day. Everyone thought Japan was going to take over the US. They're an economic powerhouse, etc. But Japan had a stock market bubble and a real estate bubble that was so severe. In 1989, it popped, and the stock market never recovered back, and it didn't make an all-time high until last year. Again, it took it from 1989 till 2024 to make
30 years.
I always feel bad. This is why I like to hear that Japan is doing well here, Rabih, because I know about the cratering of their stock market. They were a big, like we always talk about the global capitalization, like how big is each country's stock market. Japan was huge, if not the biggest, in the late 90s.
Yeah.
Similar to where we are now, being the biggest. Like things can always, I think it's a good lesson, and things can always change.
Things can always change. Major theory for why Japan took so long to rebound back is that, yes, while the valuations dropped down, Japan was losing assets at the same time. And what we mean by assets is that the economy, the demographics of this country was aging. There wasn't new immigrants or a new Japanese population to drive economic growth. Because really, on the long run, when you're talking 30, 40 periods, what matters to an economy is labor supply and how productive this labor is. Interest rates do not matter. Taxes do not matter. Unemployment rate doesn't matter. Is your labor supply growing? And is that productivity increasing? AKA, are there new technologies? This is what determines whether an economy will exist in 40, 50 years from now. So what happened with Japan the bubble burst and there was an aging demographic, that it was tough for them to rebuild as fast as they used to. So it took them a really long time to get out of that slump. And the authorities at that point, whether it was fiscal or monetary, stuck. Like interest rates in Japan from 1989 were negative until 2022. Like they were, if you look at the real rate, it was negative 0.1%. They stayed at 0%. And Japan has taken so much debt trying to stimulate the economy. Their debt to GDP ratio is 250%. Over here in the US, we're at 130 and we're freaking out, right? They've gotten to 250% and they still could not get the economy out of the slum that's in, and they were facing deflation. 2022 happens, right? Global supply chain shocks all across the world. Japan imports a lot of its energy, and all of these trickled down into inflation, into the economy. Job growth started going up really quickly, and inflation for the first time showed up in Japan, which really changed the narrative. Because Japan pre-2022 was in a deflationary period and the interest rates were near zero, and on top of that, the Bank of Japan, the Japanese central bank, didn't only control the FUD fund rate, which we call it the near-term interest rates, they also did something called yield control, aka they controlled what the 10-year Japanese yield is.
Basically the entire curve almost.
They controlled the whole curve instead of letting the market determine what the long-term interest rates are. And they did it so it's not too steep, so that inflation doesn't erode the already weak savings of the Japanese. It was more of a factor for not to affect consumption domestically. With that happening, a yield curve control, low interest rates, it meant that the Japanese yen was a very, very cheap currency for a long time, and interest rates were low. So something in the markets happened called a carry trade emerged. Everyone knew that the yen is stable across the dollar. There's no risk there. Japanese interest rates are near zero, and I can invest anywhere else in the world and get a yield. So people, investors mainly, would go to Japan, borrow, take loans, Japanese loans.
Very low rates.
Very low rates. Take that money and take it and invest it probably in US Treasury bills, paying them 3 or 4%, right? And then all they have to do is that when the Treasury bill in the US matures, you take your proceeds, you take some of the winning, you put them in your pocket. What remains from the loan, you convert them back to Japanese yen and you pay down the loan. When inflation started picking up in Japan, the central bank had to go and fight it, like every other central bank did, by increasing interest rates. When you increase interest rates, the currency becomes, the government or the bonds from this government become more attractive to other investors who are only investing in the yield. This meant the Japanese yen appreciated in value. So all those previous investors who were doing this carry trade, that were waiting on their US Treasury to mature so they can go back and pay their Japanese loan, faced a problem. The Japanese yen was increasing. So now you have to pay the loan that you took at a much higher price, which is kind of a cost or a risk that you weren't expecting, which caused the August 5th, 2024 carry trade dewinding. And if I remember, Jake was on this.
Well. Yeah.
Jake was on this podcast. It was
we talked about it, yeah.
Jake was here. And on that day, the Japanese stock market dropped like 12%, right? And the VIX in the US went up to 60, and it was like a one-day panic, and everything went back into control. So we moved from a regime where Japanese money is very cheap, we borrow it, we invest in the rest of the world, to a place where, the Japanese economy is normalizing to look like any other developed market economy where there are higher interest rates. And with that, the Japanese yen went up. And because inflation started happening and the Japanese Federal Reserve did not increase interest rates as fast as the other central banks in the developed countries did, that was very helpful for businesses in Japan. And economic activity started spurring up. Fast forward, just to make this shorter, the stock market made an all-time high. And it was a very good stimulating position that the Japanese economy was in. This made the yen start dropping again, but not for a carry trade reason, just because it's better for exports and people want to invest. So with that, this is where they sit. And it broke out of the all-time high, and it was interesting. But what happened that made the Japanese stock market jump up 5.6% earlier this week? So the ruling party in Japan just elected a new leader. And because it's the ruling party, that new leader is most probably going to become the prime minister. It happens to be the first female leader for that party. So it's possibly we're going to be having, if politics pan out as we expect this to be the first female Japanese prime minister ever, if it works. And her economic policy is very pro fiscal stimulus. There are question marks on like, how would you do fiscal stimulus if you're already fiscal stimulus, aka the government spending more money to stimulate the economy? How would you do fiscal stimulus if you're at 250% GDP, debt to GDP ratio? It is possible because the type of debt that Japan has is not similar to the one we have in the US. Like here in the US, we have almost 25 to 30% of our debt owned by foreign countries. So if the US overborrows, those foreign countries can dump their US treasuries and hurt the dollar, right? Whereas in Japan, 88 to 90% of the debt that Japan has is owned by the Japanese. So it's only like 9 to 10% of their debt is owned by foreign entities. So that if they keep on borrowing, the people who are handling that cost are the Japanese who already deal with yen rather than foreign investors. So
it's not the currency risk.
Exactly. So they have a little bit more of leverage on or a leeway on how much they can borrow. Like the US cannot get to a 250 level without a crisis. Japan can be at 250 and even go higher simply because the proportion of the debt owned by the Japanese themselves is much higher than the rest of the world. It's the country with the largest domestically owned bonds. So you're coming in with a fiscal stimulus focused probable administration, and that is leveraging optimism in the market.
So people like that. People like her approach and tone and mindset around fiscal stimulus. It's looking like she's the likely winner. People are the market's reacting.
The market reacted very positively until this morning, where there's a coalition within the leading party that decided to split between them because they're fighting over her, like on her profile. So that made the market retract. So now the fate of the Japanese stock market, because there's nothing else happening and you need this huge economic impact that would affect stocks, is tied to politics. So Japan, welcome to the US. Now politics control the stock market. But what is now happening is that whether that coalition goes into in order or not, I don't have to go into the political details, will determine whether the Japanese stock market will be making new all-time highs.
Isn't it fair to say, like, even if she gets in, like fiscal stimulus being more of a short-term approach anyway, it doesn't change the fact of what you said earlier when it comes to Japan as a country and an economy. That doesn't solve their fundamental problems, which is aging demographic, like negative. They've gone negative for a while now. Aging population, they're not replenishing their population, and then lack of productivity, as you said, that can't be solved with fiscal stimulus.
Yeah, the part of the stimulus is to borrow more and put money in, but also part on other stuff on her agenda is like, let's be more pro-immigration. But this is more into the weeds of the day-to-day Japanese politics. People do not want it. They have so many tourists. They're trying to increase fees on tourists, not to bring them in. So the idea that someone might come in, tell them, hey, let's bring in permanent immigrants to stimulate our economy is causing some rifts across, the political space in the country. So if you increase immigration, that would be a very strong path towards, pivoting the trend that the economy is going on. Will it happen? Will the internal politics allow it? Who knows? Right? Something that is also very important, because you said it's short-term fiscal policy, and I agree with you, but also monetary policy. The Japanese interest rates, they were negative or almost zero until March 2021. And then in March 2021, they increased them to zero, right? So it was 0.1. And then in July 2024, they increased interest rates to 0.25, so 25%. And earlier this year in January, they increased interest rates to 0.5. And they are still at 0.5. So they increased from way negative to 0.5. And for her fiscal plan to work, it has to go in cohesion with monetary policy. Right now, monetary policy in Japan is hawkish. They are increasing interest rates. If she wants to go in and do fiscal stimulus, monetary policy has to become either we're not going to increase interest rates anymore or we're going to cut. Because if you have fiscal policy that's stimulating the economy and monetary policy that is trying to slow down the economy, They kind of cancel each other out with political implications, polarization, etc. The last example of this happening, monetary policy going against fiscal policy, was Liz Truss in the UK 2 years ago, where she came in, wanted to do big fiscal expansions, but it was 2022. The Bank of England was literally increasing interest rates at very high paths just to curb inflation. And you guys remember what happened to British bonds and the British currency. They just took
we remember it well. Yeah, I wrote it in my. I was journaling about it that day. I went back and looked at it this morning.
Now I notice that every time you say, "Oh, I remember," you're being sarcastic.
What? Oh,
the first time I believed you.
I really genuinely do remember the Japanese carry trade episode. Jake was here. Yeah. I do remember talking about that.
Minds about it.
Yeah, I don't remember what happened to UK bonds 3 years ago. I will I will admit that. I'm here to admit I don't remember that.
Okay.
So
this is where we stand. It is interesting. And I think what's insightful about all of this, the problems that the American economy is facing, it's not just for the American economy. It's everywhere. Because we're such a globally integrated economy. If someone is dealing with lack of immigration / productivity, or someone's dealing with inflation, most probably other developed nations are also dealing with it.
Yeah. So I was thinking too. Jake, let's get you in on this.
I think it's interesting. Again, I was just listening to you, Rabih. I have not thought about this stuff as in depth as you have. So I was just sitting and learning as you were talking there. What came to my mind, and this is not a political opinion or a nationalist opinion, but I'm always just, when I hear about these economies and more of a deeper dive into other countries' economies and what they're doing, I always just come back to, man, we have it pretty good here in the US. We always complain about all of our economic and fiscal policies and our political upheaval and things, but just from a pure economic standpoint, it's amazing what the U.S. has been able to sustain over the past, go back how many decades, however many decades you want, we've been able to sustain this run for 40, 50, 60 years. It's pretty incredible, actually, with what we've done. And so I'm always just reminded of that as we do deeper dives into not even just Japan, but other countries' economics.
Such a great point, Jake. I think it's easy to get lost, obviously, in our own little bubble of the U.S. and the things that we're hearing and seeing all the time on the news and whatever. But I think it is good to get that perspective for sure. I was thinking the same thing. The other thing I was thinking is, Jake, you alluded to this earlier, but it's easy to forget the standing of certain countries at certain stages of history. And to your point, 30, 40, 50 years ago, the U.S. was trying to emulate Japan. Japan was the world leader and economy that the U.S. was trying to literally copy and emulate, and we wanted to be like them. And then to your point, Rabih, the real estate bubble burst. You think 0809 was bad? Like catastrophic for multiple, like for generationally catastrophic for their market. And so I just can't help but think of, again, foundational, what we always talk about is when it comes to investing is the importance of having more of a global view on a portfolio and not getting too far down the market exceptionalism. Like, we've had an amazing run, but it doesn't mean that this can't happen to whether it be the US or someone else. Like, global diversification, that's why it is a foundation to everything that we do with investing.
If you were a Japanese investor, you had no return for 20 years.
More, I think, like almost 30.
More, whatever.
Yeah.
It's just crazy to think about.
Yeah. And you look at the data of home country bias, again, it's generationally wealth destroying that if you were too focused in that one market. I love when we're talking about things and Rabih's nodding, and like literally nothing gives me more joy and confidence in my life.
Validation.
I'm like, yes, Rabih is nodding at what I am saying. Makes me so giddy. Okay. So we have sufficiently embarrassed me to speaking Japanese.
What language do you want to speak next week?
You threw out that at some point you're going to have me speaking Arabic. I think that one's out of the question.
That'd be awesome.
We'll see. This can't become a new tradition on 2 cents. We can't do this. Okay. Rabih, anything else on anything with do we want to highlight really quick, since people are going to listen to this over the weekend? Before we got on, we were talking about the U.S. market and what's happening in the U.S. Do we want to just hit that really quick as a little bonus
This
segment?
is more of like a breaking news, but
Yeah,
it's
yeah, 'cause you're
also
getting on.
politics driving the market. It's really nothing economic, but politics driving the market. President Trump and President Xi were supposed to meet over the weekend or etc. On Thursday, before the meeting, China decided to expand the restrictions it has on rare earth metals, which is part of the points that the US and China are negotiating in their trade deal. The US did not like that move ahead of the meeting. Are they like twisting hands, like it's politics? And as a result of that, President Trump decided to cancel abruptly the meeting that he has scheduled with Xi. So that's more of a diplomatic trouble. The market kind of reacted very strongly. We saw, indices across the board drop by over 1.5% in less than 20 minutes. And the VIX shot up straight line up. It means that people are going to hedge. Also, think whenever we still do not know how it's going to unfold. And we've got 3 days when the market is off and 3 days where diplomacy is working. So they could solve this by Tuesday after Columbus Day holiday, right? So we might come back and this could be done. But always think of this. Whenever the price is moving up and down, ask yourself this question. Are the assets that drove the return impacted?
Yeah,
If the assets are not impacted, this means you can go back to where you started.
It's noise.
Right, Jake?
It's noise.
yeah, this feels to me like a lot of investors looking for a reason for the stock market to go down. Like I think Ben Carlson tweeted about this. This last September that we just had was like the 4th best September we've had in 25 years. And since those April, the tariff scare there, the market's been on a pretty just steady incline and increase from that point. This feels like to me we were kind of like, is the market really going to be this good? Are we just going to keep going up for the rest of this year? And the first sign of, oh, maybe there's some political uncertainty. People are selling out to maybe it's just, this seems like an overreaction. People looking to have the market go down.
It totally is. And I think you both have highlighted this. Part of the foundational piece of this show is helping dentists navigate the noise. And we highlight this so many times, that the fundamental difference of trading versus investing. Anyone that's looking at this or making moves based on this news is a trader, not like
I know
a trader,
on words there.
TRADER. They're trading and they're worried about what's happening short term. If you are out there, a dentist, going to work today, actually it's Friday, you're not going to work today. And if you're listening to this, it's the weekend. So, but you shouldn't, to your point, Rabih, the fundamental assets, the fundamental like businesses that these prices represent have not changed. So this is truly the epitome of noise that's impacting this, which should not even be registering on your radar of making any moves on this. Also, do we want to do a quick S&P watch? Jake and I are here. We've made a pretty robust call to start the year. We're in October. Where are we at, Jake?
13%.
13%. Okay.
Since January.
We did call positive, and we also went on a limb and said we were going to have double-digit returns, and we're
hanging on.
Feeling pretty good. We're hanging on to that. So
I can't wait for like the December 20
sell off
the podcast where you guys give us the prediction for 2026
for the next year.
I will. I'll give you one.
Here's my prediction, and call this recency bias, but I'm sticking with the S&P being double-digit positive by the end of the year. Sticking to that. I'm also sticking to the fact that despite like last year, I made the call. It is a safe bet. The Eagles are not winning the Super Bowl this year. It is safe bet.
I didn't know if we wanted to get to that. Yeah,
we don't want to right now. It's too soon. It's too soon, but I can safely say they are a first-round exit team if they even make it. So I'm sniffing. I'm sniffing the nodes of 2023 with this team. Okay, moving on. Our 401k is propping up the Mag 7. I thought this was super interesting. We talked about last week, I think it was last week, we talked about the proportion of Mag 7 stocks representing the S&P 500. And I saw another chart here that I thought we could go even deeper on this. So U.S. workers contribute on average. This is according to from Apollo Academy, Torsten Slok. He posts, his stuff is amazing. He's always posting stuff on these graphs. But so the U.S. worker contributes an average of $8,500 a year to Ks. So we did the math before. And when I say we, I mean, I asked Rabih to do the math for us. So there's about 70 million people in the U.S. who contribute actively to a 401k. 8,500, Rabih, that came out to just under $500 billion a year. Is that right?
595 billion.
Okay, so almost 600 billion every single year going into 401ks. So what he did is he said 71% of 401k assets based on the data are in equities. This is where the data, I think, for me breaks down a little bit, because he says the Mag 7 has a heavy weight, almost 40% in the S&P 500. So what he did was he took that, he broke down that math and said about $2,300 every single year is going into Mag 7 from 70 million people. The one issue I have with that slightly is that although 71% is going into equities, it doesn't mean that's all in the S&P 500. So this is probably a little bit inflated. But either way, $2,300, let's say it's roughly $2,000 a year from 70 million people, it's $140 billion. Did I do that right? That math right? It's $140 billion every single year going into Mag 7. That's a lot of money going into this these stocks that, so the argument is, or the question is, are 401ks alone, or is there like a foundational kind of like smoothing out of like supporting these stocks and supporting the market? Because there's just so much money kind of passively going into the markets, because as we know, for the most part of all the kind of passive assets that can be out there, passive meaning people just aren't thinking about it. Ks are as passive as they come. People usually set them, they forget them. You're very unlikely to day trade a 401k. So I guess that's my question, is throwing this out there to the group. Are 401ks propping up the markets, specifically the Mag 7? I say this slightly tongue in cheek, but I think it's worth talking about.
You want to go, Rabih? Or no?
Rabih's deep thinking right now.
My answer would be yes, but it's not an absolute yes, because it really depends on the relative size of the market and the relative size of that inflow that's coming in. So, and this goes back to the idea, is the market at an all-time high versus is real wage earning growing? So if wages are growing and they are keeping up with the growing stock market, then probably yes. But if the stock market keeps going up and real wages are not increasing, aka those 401k contributions are not increasing, that inflow portion is going to be so small. So I just Googled the market cap of the Cap 7, Mag 7, and it is $20 trillion.
Yeah,
so
the total US is like 65 trillion or something, right?
So
the US is
140 billion is nothing.
Is nothing for it. But let's say a stock market crash like the one in April this year happens and Mag 7 are down 30-40%, right? Well, now you're talking about 10 trillion, and that inflow has double the effect because it's now a bigger percentage. So on the long run, I would say those contributions from 401ks support the market from bottoming down too much. But I do not think it sets a floor, but I do not think they are not what's driving the stock market, especially the Mag 7, to make all-time highs every single month. This is where I would differentiate.
Yeah. I don't know if it's a risk that like, oh, because of 401ks that this Mag 7 is just going to keep going bigger and bigger. Like Rabih said, if we have a 2022 and some of these big stocks go down 30%, that wipes out a lot of gain in these accounts. I think it does pose a risk on the individual level. Like we've talked about this, like if your 401k is solely in just an S&P 500 index fund, which historically has not been a bad investment, but right now it's a pretty concentrated investment, again, where you're getting 40% of your portfolio is going into these top 10 companies or top 7 companies. You may think you're diversified, but you're not as diversified as you think. And so I would be more worried about this maybe on an individual investor level. If you have a 401k that's just in the S&P 500, you're really betting on the Mag 7, which can be volatile, and we don't quite know what's going to happen over the next couple of years.
That's a really good point, Jake. And Rabih, I'm glad that you brought the global numbers. By the way, I should have started with this to start the show. I'm a little under the weather, if you can't tell with my voice. So
you've been great.
But we play through. We play through.
Yeah.
This is the Jordan game. But I'm glad you brought that perspective, Rabih, of the global numbers. I don't look at it as a risk as either. I think what you said, and I've heard this argument made before, that 401k balances and retirement plans, there's $12 trillion in 401ks and there's all these contributions going in every year. There's an argument to be made that it does smooth out because it props that floor up. So it does smooth out volatility over the long run, the bigger those assets become. So I do think I actually look at it as a good thing. I actually look at it as a good thing where people are not thinking about their foreign. This is why I was so irritated and still am of the changes that the Trump administration is making the executive order of allowing private equity into 401ks, because I look at this as the benefit of a 401k, the structure of them kind of naturally puts them out of sight, out of mind. That's a positive. That's a good thing for the investor. But Jake, I love your point too. At the individual level, this is risky, and why we're not proponents of just a set it and forget it S&P strategy, because look what's happening right now. 40% of that thing is in 7 stocks. That's not proper diversification. Any other thoughts on this? So I think we've answered this. It's not propping it up, but it is something to just take note of how much money is actually going into these things.
It's bringing in money and it's acting as a support. And the reason it's acting as a support is because when the market is panicking, the last thing you're going out there to liquidate and panic sell is your 401k. You're usually starting with your brokerage account, with the stuff that are easily accessible.
Yes.
The fact that you can't go and liquidate your 401k, and actually you have to submit a request, and the other guy on the other side has to do the liquidation for you. It could not be at the same time, right? The fact that it's inaccessible is the gift here, because it supports the market. If we talk about it, all of us doing the same decision in the country, but also it's good for you because you're not selling at the low.
401ks are awesome. Don't forget it.
They are awesome. And we talk about this, this whole idea of like people. So we actually have this, Jake, you and I have had these discussions going back 7 years around like optimization of like, is Roth better than traditional or whatever? And we've had these discussions around, are 401ks even worth it? Like, we've had these discussions. And I think there's a lot of dentists out there we've talked to that are trying to like always optimize, like what's the best vehicle? Rabih, you just highlighted it. The barriers that are there between you and your money with a 401k, that alone makes it worth it. And will over a 30-year period or 40-year period make it a superior vehicle to invest in because of that, because it makes it harder to get to.
And the nature of automatic contributions through your paychecks that you're getting every 2 weeks. I mean, very few people contribute to an asset every 2 weeks or however you get paid.
Without even thinking about it.
So like that alone, just coming through having the automatic nature of contributions is awesome.
Yep. Yeah, systematizing it. So, okay, I think we thoroughly diagnosed the 401ks and Mag 7. Let's finish up with Jake. Is renting back?
Yeah, do we want to talk about housing here? We'll pivot from the stock market a little bit.
Yeah.
Did you guys know that since 2023, the number of people renting in America, the number of renter households has surged 1.6 million people since 2023. For some context, it was stagnant the past 6 years. So it's taken a jump really since 2023. A lot more people are renting.
I didn't know that, but it's not surprising at all.
Yeah, I guess the main reason is probably obvious that housing has continued to be really expensive, and so more people are renting. Historically speaking, I think a lot of people say, well, that's a bad thing. Like we want, the American dream is to get into home ownership, build some equity. That's where you need to go to. I want to just present a take that maybe, don't hold me to this, for all the listeners listening.
Jake, let's go.
For all the listeners, like, don't hold me to this. I'm just thinking out loud here.
Hold you to this.
Do we need to change the American dream a little bit? I've just been thinking about this with housing, where it's like everyone just like we talk about the reason people are so frustrated with the economy. I think a big part of it is simply housing. Like that's like a lot of the frustrations come from that. And I understand housing is broken, but I wonder if we need to change our mindset to be, maybe I don't need to get into a house. Maybe getting into a house shouldn't be the end all be all for everything. So here's some numbers. Bloomberg they just pulled some data where they looked at the top 50 largest metro city areas in the United States. So essentially the 50 biggest cities in the US. Of those cities, 49 of the 50 cities, it was cheaper to rent than to pay a mortgage on a home on average. The only city that wasn't is Pittsburgh. Shout out people who live in Pittsburgh, where owning a house is still a little bit cheaper. But every other large metro city, it was far cheaper to rent than to buy a house. On average, that difference was $908 a month. So renting $900 cheaper than owning a house. That's a pretty significant chunk of change for a lot of people, again, on average there. So I just did some math. Like, let's say you took that $900, put it in the stock market for 25 years at an average 10% rate of return. That's over $1 million over a 25-year period. So if you just said, hey, I'm going to do this rent thing, save $900 a month, I'm going to invest in other assets, I will accumulate $1 million over the next 25 years. For the sake of comparison, if you said, okay, well, you were going to put that $900 towards a house, like I want to buy the house, I'm going to take on the $900 extra expense. Median home prices in America now are about $400,000 is the median home price. On average, houses have appreciated at about 4% per year on average. Again, I know it's been higher in recent years, but on average, it's about 4%. So over a 25-year period, including that leverage of a $400,000 home, your home would be worth about $1 million in 25 years. So you're coming out about the same, right? If we said, okay, if I'm putting 900 into a house with some leverage or putting 900 in the stock market every year for 25 years, you have about $1 million both left over there. Of course, the big difference here is one is an asset that you can use for retirement goals. The other is a place you just have to live in, and you always have to have a place to live, and you're usually not accessing home equity to fund financial goals, not to mention all of the upkeep costs and interest costs and all of the maintenance costs that we don't factor into the housing equation. And so my point here is, and I want to get your guys' take, with renting being so cheap here recently compared to housing, I like that 1.6 million more people have gone into renting. I think that can provide you some flexibility. And I don't think you need to build wealth in a home, like to be happy. Like, I wonder if we switch our American dream to, I'm going to spend so much money on housing to, I'm going to save on housing and maybe spend that other money on investing, or maybe going on more vacations or more concerts or doing other things that I like with that $900. Is that worth it to me rather than just stocking that away into home equity? Thoughts?
Yeah. You want me to go, Rabih?
Don't come for me in the comments if people are like, no, this is a bad thing and we need to get everyone a home.
I don't disagree at all. I think we need to, I'm with you on the American dream. I think part of the frustration, to your point, Jake, is more of a psyche issue than it is anything else, of like, and the harsh reality that housing is more expensive. That is frustrating for sure for a lot of people, that it's like, oh man, I was promised this life that my parents were promised, and now it's way more expensive for me to have that same life. We've also highlighted this many times, that people don't want to admit that the expectation inflation is far outweighed real life monetary inflation. Like, it's not even close. Like, what we think a good life is versus what our parents did, 30, 40 years ago. But the thing I'd say too, Jake, is I think we need to get away, and it sounds like people are, maybe they're forced into it, but just get away from like the natural implication that renting's worse than buying. Like, that's just a natural thing. People are just like, renting's worse than buying. You got to get away from that mindset that ownership is just like the ultimate, always the best way, which I think most people think, that like renting feels more temporary and I have to own a home to like have made it. I think that mindset has to go away. To me, maybe it sounds trite and cliche, but it's like the American dream should just maybe be like, live the life you want based on your terms, based on like, if it's renting for your whole life and you're saving that money to go travel, cool. If it's owning a home, awesome. That's great. But this kind of like overarching, you have to own a home to be fulfilling the American dream, I think that is going away. It has to, I think, a little bit.
It's one of those things where I think most people want to own a home. And historically speaking, that's how most of America has built their wealth in the housing market. If we look over the past 40, 50 years, because that's the only investment that everyone has had access to, and the only investment that people contribute to, if you want to call it that, in form of a mortgage every single month for 20 or 30 years. So I think that's historically how it's been. Like, if we look at previous generations, it's like, oh, they built a lot of wealth through real estate in their house, which is awesome. But I just wonder if we could change that dynamic a little bit. Like, I talk to a lot of people who are like, well, I can't buy a house and do all the fun things I want to do. And it's like, well, what if you just didn't buy the house? What if you rented and you could do the fun things you want to do? But they can't square that in their brains. It's like, no, I want to be able to buy the house and do all the fun things. Maybe we need to work on that as like policy to make that be a reality. But if it isn't a reality now, we just have to like make some, I guess, sacrifices or trade-offs there. I'm not going to own, but that'll allow me to do all these other things, and maybe allow me to put more money into other investments that are going to grow my wealth just as much, if not more, than a home.
Yeah. Let's get Rabih in on this.
Before I give you my definition of the American dream, a question that came to mind is, like, have you ever met someone who said, I am now so rich because I bought a house and the house is now worth $2 million? Like, they're still living this, like, they can't access this $2 million. So did you really become rich if it's an asset that you use, but it just appreciated in value?
It's going to be passed down to your kids at some point, that they're going to use it.
It doesn't translate into changing your day-to-day routines, habits, expenses, quality of life, just because the house value went up, right? The house is still the house. Yep. When you bought it and you had that same, like, you might renovate it a little bit in between the holding period, but this is not going to increase it. This is where the dissonance is formed. It's like, I want to meet someone who's going to say, you know what, my house appreciated by 50%, and now I can flex on you. I'm much richer. Your quality of life is still the same.
Well, I do think there are people like that who they just like the idea of, oh, I'm building this on paper equity. That just feels better to them, right? Than the quote unquote throwing money away through renting, which I don't agree with, but that's always the term that you hear. Right.
Yeah, I think that's fundamentally why people immediately will, if you ask most people to identify what's better than the other, even financially, without even knowing any of the numbers, just the mindset, most people would say owning over renting. Like renting, I think in America always feels temporary. Like, oh yeah, you rent, but it's temporary. Like you're eventually, the assumption is you are moving towards ownership always. I understand it as someone who's owned homes throughout his life.
I own a home. Yeah.
I get it. I'm not, I get it. So, but to your point, Rabih, I do think sometimes people are a bit delusional about the numbers or the impact on their wealth, or not looking at the counterfactual that Jake just highlighted, which is like, well, what if I just would have rented? And what else could I have done with that money, that down payment I just put in this house that I'm never going to really like access? Technically, you can get that equity, but most people are not thinking of it like that. Because you have to remortgage the home, reverse mortgage it, whatever it is.
If you think you're going to downsize in the future, you may be downsizing, but the homes got cheaper. Got more expensive, and so you're actually not paying a cheaper price. It's like, oh, I built up all this equity. I'm going to move from a 5-bedroom house to a 3-bedroom house. Well, guess what? That 3-bedroom house is now more than that 5-bedroom house was when you first got it.
And not only that, we've said this many times, you're going to possibly downsize. You're never going to down quality ever. So people just don't do it. So yeah, this is the old, like, people are always more disciplined in the future. Like they're making plans on things of like, oh yeah, I'll be disciplined in the future. I'm going to go ahead and downsize in the future. I'm going to cut those costs in the future. No, you're not. You're just not. So Rabih, back to you in the studio.
Back to me. I have a hypothesis for why we think the house is part of the American dream. With a disclaimer, and I think I've said this on the podcast beforehand. For me, the American dream is not about anything monetary or economic. It's more fundamental human values, the rights that you get that are not guaranteed elsewhere in the world. And this is more important than any penny you put in your pocket, But putting that aside.
Just end it there.
That was really nice. Yeah.
That was beautiful.
Putting that aside and focusing on money, I think the promise of the American dream, which is still valid, is socioeconomic mobility. And for a long time, we only associated that with housing. Owning a house is your path to socioeconomic mobility. Right now, the house is not the most efficient way to build that socioeconomic mobility. Investing is, starting your own business is, etc. So while it's still there, it's just lagging in the race of the best tool to get you there. But the dream of, yes, you do not have to live a life very similar to the standard of living and quality of life that your parents had, and you can have it better, and your kids can have it better than you, is the American dream, economically speaking. It's how are you going to get there? Which tool are you going to use? And home ownership is just a tool. So if we put it in that perspective, just broaden the horizon and look at all the other opportunities that will make your life economically better.
I think it's a great point, Rabih.
Yeah, I don't feel like I need to add much more there. Yeah,
I know.
This is for me, it's less of a hit on housing, and I own a house. There's a lot of value in owning your own home. I get it.
Yeah.
More of a, it's okay to rent. And in some instances, depending on where you're at in your career, if you need some flexibility, if you have cash flow issues, renting can actually be an awesome thing for you and allow you to propel some wealth into the future.
I'm glad you said that, Jake, because this is not anti-house or owning. This is not anti-owning. I think it's letting people off the hook of saying, it's like giving you permission to say, hey, let yourself off the hook if you're renting. That's okay. Like renting is totally fine. And in some cases, it actually financially might be better for you. The one thing I was going to say too, Rabih, to your point is, I don't know this for certain. So, I'm going off vibes. I'm going off vibes, as they say, vibe investing. But I do think the vibes with the youth is actually changing quite a bit, in the sense of we might be entering a new kind of mindset of like a renter's mindset, not only with homes, but like kind of the Airbnb mindset, or I've read things and heard people on podcasts talk about like the future of cars. They will no longer, like there's a future possibly where we don't even own cars, or less ownership of cars, where
for that future.
Yeah. Like it's kind of interesting. Yeah, me too. But I do think it would be interesting to see, we will see, hopefully all of us 20, 30 plus years in the future, if this psyche does change. It does. what the American dream, quote unquote, or what we value changes with generations, and I could totally see this. So, but Jake, I'm glad you wrapped it up with that. This is not anti-ownership. This is just saying, hey, it's okay to rent. There's nothing wrong with it.
$100 on average. That's a pretty big difference. Anyway,
Pretty big difference there.
Yeah.
And I also loved mic drop moment with Rabih of what the actual American dream is. It's about values, not
beautiful.
yeah, and or socioeconomic mobility. I love that.
Which we're still seeing.
We are.
Everyone's always like, the shrinking middle class is a big topic, and that's been happening. But a big reason is because people are moving to upper class. We have a lot more, like the upper class has gotten bigger. And so we are seeing economic movement. That anyway,
we've never been richer across the board, not even as a country. I'm not even saying, yes, there's a gap. Of course, we know that. But across the board, we've never been richer as a country and as individuals on an average basis. Okay. That was a lot, guys. That was good. Any other final words of wisdom from you two? Okay. If you're still here, you're one of the cool ones. Thanks so much for listening. We would love to talk to you. Dentist Advisors talks to and works with hundreds of dentists all over the country, helping with anything from investing to financial planning and overall wealth management, practice strategy. We would love to talk to you. Also accounting, bookkeeping, and tax planning as well. So if you're out there listening thinking, man, I just need to call these guys, I think it's time. I think it's time to call, see how we can help. Go to dentistadvisors.com, click on the yellow book free consultation button. For now, Jake, Rabih, thanks for being here and sharing your wisdom. Everyone, that was our 2 cents. Till next time, have a good weekend. Bye-bye.